I'm Jenny Mattingly. I'm our Vice President for Government Affairs here at the Partnership for Public Service. And for those of you not familiar with the partnership, we're a nonpartisan nonprofit working to build a better government and a stronger democracy. And we do that through policy ideas to make government work better, leadership development, workforce programming, and convening conversations like this one, really to support the federal workforce and answer all the questions we're hearing, because we know there are a lot of them out there. And we really are here to support you as best we can, providing resources, plain language, explainers, continuing to share the stories of all the incredible work that federal employees do day in and day out for this country. And that's especially important as Public Service Recognition Week is next week. So just a big thank you to all of you on the line this evening. So really appreciate your service and know that we are all here, those of us online and a lot of folks around the country, to support you in the work you do. Before we dig into the content, I'm going to share a couple quick housekeeping notes. Throughout the webinar, we will answer questions that you put in through the Q&A chat. And we will also try to answer some of the questions that may have been submitted while you were registering. These questions are anonymous, so please feel free to pop questions throughout the Q&A. I will not be able to, unfortunately, address every question tonight because we've got quite a few folks on this webinar. So if you have a question that's not answered, or if you have more specific individual circumstances, we certainly encourage you to reach out to HR staff, seek legal guidance from your agencies or an outside attorney, and then continue to find folks like our guests this evening and others out there who can help support you and answer questions. One final disclaimer before we get started: the content provided during this session is for informational purposes only and is not an endorsement of any particular path of action, any particular firm, any other things. It's information that's general. It provides an overview of processes and considerations and offers some inroads to potentially helpful resources that might help you as you're considering all the actions out there and things going on. What you hear today is not intended to provide any legal guidance. If you require legal advice, we recommend consulting with a qualified attorney who can assess your unique circumstances. So now that we have that out of the way, Delante, Nick, I'd love to have you introduce yourselves to our audience. You're our esteemed guest this evening, and would love to give a quick overview of who you are, what you do, and then we'll jump into the conversation. So I'll leave it to both of you to choose who goes first.
Hey, thank you, Jenny. I'll go ahead and kick things off. Hey, good evening, everyone. My name is Nick Abrams. I'm certified financial planner with the firm Opulentia. We're a financial planning firm headquartered in Maryland, but we service clients all throughout the country. We have done a lot of work with federal employees for the last almost 15 years, both going into agencies doing training, but also working with national organizations doing training for them. So really excited to be here for this event.
Great. Thank you, Delante. Over to you.
Yes, and thank you for kicking everything off, Nick. My name is Delante Greer. I'm the financial planner and chartered federal benefit employee consultant here with Opulentia. I'm really proud of the work that we've done. As Nick stated, we work with agencies and affinity groups across the country. I'm the son of a federal employee and a former police officer, so this subject really hits home, and I'm excited to answer any questions that you all have today.
Great. Thank you both for being here, and especially, thank you for all the support you've been giving folks, because I'm sure you, like we have, are hearing so many questions from feds about what to do with the deferred resignation program, or DRP, what to do with VERA, or early retirement. There's lots of what to do with the RIFT and how to think about it, particularly given financial considerations, right? And that's a huge thing. So one of the things Delante and I were talking about before this conversation got started was, I said the piece of advice that I try to give every federal employee is to download their SF50 and check and make sure if the information is correct. Because what I've does it have your appointment type? Does it have your years of service? Does it have other considerations? Because what I'm hearing from folks is that sometimes it's not correct, and that's going to impact their benefits calculations. It's going to impact other things. And so I thought, since that's my always opening piece of advice to folks, I get your thoughts on what that advice is and what people should be thinking about and why it matters.
So I would say you're definitely right, Jenny. But even more than that, we tell clients, you want to know your numbers, but you also want to do an assessment of yourself professionally and personally. So as you're going through these changes, one on the professional side, you want to look at what skills and skills and circumstances that you have. Each person, especially being a federal employee, understanding that you are part of running the largest government in the world. You were hired for a reason. You kept the government running. So you have certain skills that are really marketable and manageable, not just on the federal government level, but could be in private sector or on some type of consulting basis. So you want to have an assessment professionally. Also, on a personal side, you want to have an assessment of what does this look like for you? What is life after going to look like? Is this a permanent retirement? Or is it going to be a temporary retirement or a part-time retirement? And then definitely on the financial side, assessing the numbers, looking at what your numbers look like as far as retirement, also looking at your thrift savings plan, but looking at your expenses as well. So that is really what we're telling a lot of people right now. This is the time to take that assessment because we're in uncertain and unprecedented times. We don't know what's going to happen next, and you really need to be prepared. So just understanding where you are personally, professionally, and number-wise really helps. And I'll let Delante kind of go ahead for that, but that's the advice that we're starting to give the clients, um, and it's really be helpful to them.
Absolutely. And just to piggyback off what Nick said, first thing before you even look at the numbers is take a deep breath, because this situation that a lot of people are finding themselves in can be abrupt and destabilizing, and you still want to be able to take control of it. So one of the first things we're going to ask you to do is look at your benefits and your severance options and dig deep. Start asking questions. Do I have any unused leave payout? Is there a separation incentive? Most people don't even know that exists. So if you hear Visa, they have to pay you if you accept this deal. Start asking those types of questions. If you need coverage, because health insurance is expensive, it went up over 13% this year for FEHB. So look to see if you still have care available. So if you want TCC or spousal coverage, see if that's going to be offered to you. Otherwise, you may have to pay for it yourself or go to the marketplace. So these are some of the first things you look at. The next thing, as Nick stated, when you're looking at your TSP and your retirement benefits, is digging a little bit deeper as to what you want to do with it. What is the next step? If I make a break from the government, is this going to be a clean break? Do I want to roll this over? Or do I have some special options that are offered because of how the separation took place that will give me the ability to make withdrawals without facing extra penalties and extra taxes? Now, on a more in-house note, you really just want to tamper down the spending, and that is just in general right now. The workplace is unstable. You have the tariffs. If you haven't felt it yet, give it some time, especially if you like to do a little bit of retail therapy. So just all those different ingredients together, now is the time to really be intentional about beefing up your emergency savings. Usually we'll say 3 to 6 months. I'm going to go ahead and say 6 to 9 months, just so that you can have that peace of mind. And then that's going to help you once you figure out what your next step is, so that you don't have to take a bad deal. As Nick stated, you all run a government, you can negotiate with that experience that you have. But if you need $1 tomorrow, you're not really in the position to take your time and assess everything. So having that extra bit of funds set to the side just in case will buy you not just a peace of mind, but time also to figure out what's the best move for you and your family.
I think that's a
And I'll kind
great
of
point
piggyback
about,
on
oh,
that.
go ahead, Nick.
No, I say, and
Jump
kind
in.
of piggyback on that, what we're seeing clients, we've had several clients that have taken their skills that they had from the federal government, and then that they have now gone into consulting and are doing very well with it. So there are a lot of options out there. Don't feel like you don't have any options, but really taking the time to kind of think about things and looking at different options and being creative can really help turn this ugly situation into something very positive.
Yeah, and what I love about what you all are saying is so many things feel out of control right now, I think, for a lot of folks, but that's something you can control, is
Yeah.
starting to be intentional about setting yourself up for success after with whatever comes next. So that's a great framing, I think, for folks, is to say these are areas where you can take control. And so, but you have to understand what I'm hearing you both say is, what are all the different pieces that you need to know about and take control of when you think about doing this analysis of what you need to live, what you need to do? I heard healthcare, I heard, looking at some of the other needs, heard economy. What are some of the other ways you tell folks to think about? Is it, I'm sure childcare is one. Is it lifestyle? Is it, what are the other considerations to think about so they can make an honest assessment of what they might need financially?
So I think the key word you said was lifestyle, and that's the biggest one. Everybody has their own individual lifestyle. Some have a more conservative lifestyle, a more frugal lifestyle. Some have a more extravagant lifestyle. So one of the things that we always talk to clients about in general is, what do you want this to look like for you? That's the key. And that's a hard question to answer, especially in turbulent times, but it helps really to focus on the numbers. When you have things done conceptually or holistically, then we can take the numbers and say, okay, how do you make this work? What needs to be done to make it work? And that really helps to answer a lot of questions. A lot of people, there have been sometimes we've had this conversation with people who have gotten, the letter or terminated early. But when we looked at things, they were in a good position to go ahead and retire. But they never looked at the numbers and never sat down and talked to anybody to see what it was like. Unfortunately, there have been other sides of that as well, where we've had to say, hey, this is not going to work. You're going to have to find something else. And that's a whole different conversation, but it goes back to that professional and personal assessment just to see what skills that you have and how to apply them. There's still a shortage of people in private sector, private industry. So there is a huge need out there, and it's just really understanding what you bring to the table as well.
And I think the good thing, Delante, I'm just going to jump in. One thing we've heard from others is to, feds aren't used to negotiating salary and thinking about what they need always in that sense. And so the assessment I hear you making would then help people understand what sort of salary, benefits, other things they need from their next job too, to make them whole, to move forward. So Delante, love your thoughts.
Absolutely. And times are changing. So most people who have worked for the government, one of the biggest things that you look for, that pot of gold at the end of the rainbow, was a three-legged stool, where you have your basic annuity, your TSP, and Social Security. Well, now it's time to maybe turn that stool into a chair and start looking for different options to make that ancillary income work in your favor. And so when you're looking at things like negotiating your next salary or creating outside investments, it's more important now than ever to start taking this in-house. And I don't know if you all have paid attention to any of the recent news. They're already talking about stripping different benefits. They're talking about getting rid of the annuity supplement, putting more into the TSP, lowering the payouts. And so with that mindset, it makes sense to just get in front of everything and start comparing what you're worth. So if you have a certain skill set, or if you have an education, see what the private sector offers. And, and I'm not joking when I say this, but the reality of it is there have been layoffs and rehires. Don't just go back in without asking questions. In that time that I was at home, I had time to really assess my situation, and I think I'm worth this much. It's as simple as asking questions, which, as a former government employee, maybe not federal, but it's very similar. You're taught, hey, this is how the system works. Just work a certain amount of time, you get your pension, everything takes care of itself. We're in the space of asking questions and creating additional assets for ourselves, or income streams, so that you're not as dependent, so that this feeling that you feel when you get that letter, you'll never have to experience that again.
I think that's it's the forward planning. I know we've got some folks on the phone who are probably already on admin leave. They've taken the DRP or they've been RIF'd. And then we have others who are still inside government wondering what they can do to prepare. And so everything I'm hearing is there's a path for both people, both groups, to both deal with any sort of termination or removal, but then also to prepare if they're still inside. And Delante, you mentioned something that's actually a question that folks are asking online right now. You mentioned some of the actions that are being considered around changing the first supplement, the supplemental annuity, the potentially high 3 to high 5. It's things that come out all the time. And to the point that you raised, these are all conversations right now. Nothing has been changed. Everything's still the way it is. Is that correct?
Yes, it's still in litigation.
Yep. And Congress is considering things. There's, but no change has been made. And one of the folks online asked if there were retroactive changes that could be made to their pensions and to calculations. And I think that for the folks on the line is still an outstanding question. So for right now, you plan around what the rules are and what you know. So I'll say that there. One other question that folks are asking online, and the early retirement, the supplemental annuity, which hopefully we can pause and explain in a minute, is making me think about this. If somebody is eligible to maybe get the minimum retirement age plus 10, which is one form of retirement, should they postpone retirement and wait till age 62? Should they take these early retirements? What bridges the gap if you retire early? Could you all talk a little bit about the parameters around early retirement and decisions in there?
Absolutely. So it's a nuanced answer. So I'm going to give a few different layers, right? So when you get that Vera offer, it may be tempting, especially in such a stressful environment, but there are a few things that you have to assess. So you mentioned deferred or postponed retirement. So those are two different things that you are eligible for once you have at least 5 years of credible service. Even if you've separated from the government, as long as you have that 5 years, you can come back later on, usually around age 62, where you start collecting Social Security and apply for your pension. And then you'll receive that monthly check based off of your years of credible service and your salary while you were working with the government. Now, if you have MRA, so minimum retirement age, and the 10 years of service, that gives you postponed retirement, which is a little bit different. So when we're talking about deferred retirement, you don't have eligibility if you've already separated to receive your FEHB or your FEGLI benefits. Now, if you've already moved on to the private sector, you may have actually gotten a set of premiums that you prefer, which that's not necessarily a bad thing. But if you need the FEHB or the FEGLI, which is a huge benefit for most people in their retirement because the government pays a portion of it, then you may want to start leaning towards the MRA plus 10 because you'll still get that same check. You're deferring the pension basically, but now you also have the potential to collect that FEGLI and FEHB benefit in your retirement. So that's just a decision that you make, hopefully before you sign your VERA or your retirement options, as to, do I need this money a little bit sooner? And do I need these benefits? And then I'll add one more tier to it, which is really important. If you decide to retire early, you have to expect a smaller payout. And that's not necessarily a penalty or anything like that. It's just the way that the math has to work, because now you're receiving a payment for the rest of your life. And so whereas you may have waited until you were in your mid 60s, and let's just say off of life expectancy, that's going to be 30, knock on wood, hopefully 40 years of payments. Now the government's looking at it like, hey, we may have to pay you 40 to 50 years. So we need this money to stretch out a little bit longer. So you just want to consider all these moving parts before accepting that deal. And sorry, not to be long-winded. You did ask about the annuity supplement. Do you want me to just answer that later, or?
Yeah, no, go ahead and explain it now. That'd be great.
Okay. So when looking at the VERA, that's another important nuance that you want to pay attention to, because yes, you have this payment that's waiting for you, but if you're under the age of 62, you have to see if there's going to be an income gap, because if you didn't work what they call a regular position, or you don't qualify because of your years of service, there's a payment that you can use as a bridge almost. So let's say you retire at 57, it'll give you an additional amount of money per month until you turn 62, and that'll offset the shortage of what you're not receiving in your Social Security just yet. If you take the VERA and you don't qualify for that bridge, you have to make up that extra couple of $100 a month on your own. So that's where we bring in that fourth leg that I mentioned earlier, is looking to figure out, does it make sense to take this money from the TSP, or do you have some other assets, or do we take a portion of the TSP and create that supplement for you? And so that's just an ongoing conversation, and each situation is different. And I would love for Nick to chime in, because I see his lips over there moving. He's ready to say something.
He's got some
No,
advice he's going to jump in
I was
with.
enjoying your analysis, Delante. No, I would just say as a follow-up, before you make any decisions, we always encourage everyone to please talk to a professional. There are so many nuances, and everybody's situation is different. So before you sign any papers, make a decision. Find a professional that you trust. Find somebody that is certified with federal benefits, that understands how federal benefits work, and hire them to help guide you through the process.
Yeah, that's right. I mean, because the reality is this is all complicated, and this might be a point in time to step back and say, for folks who may or may not know, let's talk a little bit about annuities, because we've talked about that and how annuities are calculated for folks, and what goes into the annuity that people, because it is separate from the TSP, the thrift savings plan, right? And so separating out what are the elements of the retirement annuity for folks.
So when you're looking at your basic annuity, which has the nickname of the high threes, it's attainable to do a rough estimate, but there are a lot of moving parts that makes it complex really quick. So if you're taking a high level view of it, you have your years of service, which gives you a percentage rate. Then you have your high threes, which is your highest 36 months of consecutive pay. For most people, that's going to come right before retirement, just based off of time and their position, their tenure, their GS level. But if you had a promotion earlier, or you had a special assignment, your high threes may already be past you. So you're going to use the average of that. And then there's a multiplier, which is either going to be 1% or 1.1%, depending on what age you are when you retire. So that's at a high level. When you start digging into the weeds about military service, even if you're in the process of a buyback, if you have prorated time, if you have part-time work, even if you're looking at phased retirement, these are all moving parts that you have to calculate. And you can't use overtime. You can use locality pay, but certain types of income don't count towards your high threes. And so once you have that, then you're able to get a rough estimate of what your annual payout is going to be from that basic annuity, and then you just divide it by 12. So I know that's a lot of math, so I'll just repeat it one more time. So you have credible service, which is going to be a decimal point, multiply it by your high three number, the average of those highest 36 months, and then you, depending on if you're over or under the age of 62 in your years of service, you multiply by 1% or 1.1%. Now, there's an extra nuance on top of that. If you are looking at a VERA, as I just stated earlier, but I'm going to repeat, your calculation may change, because you're going to get a different payout from someone who takes their full retirement, because that calculation is based on their full credible service. And this is just to bring up a point that Jenny made earlier. It's really important to make sure that you have your SF50, you have your DD214, that you're reviewing this paperwork, and that you have a hard copy so that the numbers match your records and your recollection, just in case you need to bring it back to the table. But if your numbers are short, or even if you just take a VERA where that money needs to be stretched out a little bit longer, that's going to change your calculation. So before taking the deal, make sure that you get in touch with either your HR department, talk to someone from OPM to get a benefits estimate, or as Nick has stated multiple times, talk to a specialist so that you can get that information to get an accurate benefits estimate, not just some numbers that you pulled out the sky.
Yeah, that's right. And I, for folks on the call, the webinar, I want to reiterate that sometimes on your SF50 or your paperwork, the years of service may not be correct, or there's some other things missing from service or other things, awards, other things that you got during your career. And so it's good to double check, because it's just not always the case. And the impact on that is going into the benefits calculation, right? It's not just there. So Delante.
Yes, Jenny, I just want to piggyback off your statement. Even if you've got your SF50 at the beginning of the year, please double check it. Get an updated one. We've had multiple instances of the numbers being just slightly different. And that can make a huge difference because if you don't check it today and you look at your statement that you end up pulling, let's say in May, and you go off of that and it's not correct, you'll continue building your future based off of that. And not to, go worst case scenario, but let's say you're someone that has military service or something like that, and then you retire, and then for some reason it's not correct on your SF50, you won't get that benefit. You already signed off on it. Now you have to go back and request. And we all know that, when you're dealing with public entities, it can take a little bit of time to get a request pushed through properly. So save yourself a lot of headache, heartache. Make sure you're getting an updated version of the SF50 and your certified summary of federal service.
It's interesting because you brought up a point that goes to a question that we're getting from the audience is around timelines. And so, because it does take time to get retirement processed, it does, once you submit the paperwork, I'd love to know what you all are seeing, sort of what typically you see when somebody is ready to retire, how long it takes before they get payments, and is that changing at all given all the uncertainty and upheaval in the government?
Oh yeah, Jenny. So it's interesting. Before, all of this happened, when we saw clients retiring, the December, January timeframe was always the busiest time. So generally, our rule of thumb was if you retire December 31st, January 1st, don't expect your first annuity check until probably March or April, and that's usually a partial check. Nowadays, we're telling clients expect a longer time frame because of everything that's going on. We're saying probably about 6 month time frame. So you want to be prepared, as Delante said earlier, to have that nest egg build up, 6 to 9 months nest egg build up, because it might be a while before you get your first check. So if just kind of everything that's happening, the mass exodus that's happening right now in a lot of agencies, it's just taking a lot of time now to receive those checks.
That's right. That's what I was, you sort of voiced what I was worried about, which is
Yeah.
that it's going to just, because of everything going on, it's going to have to take longer. And I think people are sometimes surprised that they don't start getting payments right away. And so it is
Yeah.
something to take into consideration.
And to piggyback, one other thing I will say now, the leave check does come sooner. So that does help provide some bridge way to that. It usually factors in with your last paycheck. But on the annuity check, it's going to be a while before we're seeing client get that check.
That's right. And so when you, just for folks, I'm sure people on the line know this, but when we're talking about leave checks, that's going to be your leave payout for, if you could clarify just for
Yeah.
folks what they should expect in terms of a leave
So yeah.
payout.
So that
Is
is,
it
the
annual
payout,
and
depending
sick
upon how
leave?
much annual leave that you have not used, that you're allowed to cash in on. That is paid out when they send you your last paycheck. Now, the other thing that disturbs people, they do withhold taxes from that. So generally, when you're expecting that amount, understanding the way exemptions and withholdings work, it's generally a large chunk of that will go to taxes. So a lot of people are expecting that amount to kind of carry them over, and then they get shocked when they get that last paycheck, and they see what the gross amount is, but they also see the net amount that they actually receive.
That's right. You said another word that I wonder from, Nick Delante, what you think about. You said the word taxes, right? Are there any, a favorite word, are there any tax considerations? We're talking about people thinking about, early retirement, thinking about full retirement, or thinking about taking the DRP. Are there any tax considerations besides it coming out of that paycheck in that first one? Is there anything else people should be thinking about?
I mean, I would say just understanding that, when you're looking at your numbers, whether it's the annuity numbers, um, uh, any special payout that could happen, that yes, it's going to be taxed. But also understanding when you look at your annuity numbers that they do not focus in on state income tax. Generally, on your annuity statement, when they run that projection, they'll have a projection for federal, and that may or may not be the right number for you. But also, you have to figure out the withholdings for state income tax. And so, once again, talking to a tax professional on that is very helpful. But also, kind of understanding, how this will change your income as a whole, a household income. So, there's a married couple um, where you're filing jointly, and you're separating from service, and you decide, well, you're not going to go back to work. Really sitting down looking at how that will affect you tax wise, and it could be a benefit because less income is coming into the house. So kind of looking at how to make adjustments to that with your partner or your spouse's pay to kind of compensate for that with their exemptions that they're withholding from their job. So there might be a good time to make some changes to the exemptions that they're withholding, because the income typically will be less coming into the household if we lose that income from that other person.
That's helpful. Delante, you had some thoughts too.
Yes, and Nick made some great points. So I'll focus just more so on retirement and then also your residence. So when thinking about TSP, some people actually have the misconception that my TSP doesn't owe taxes when I take it out, even if I retire after 59 and a half. Most people put their money in a traditional TSP, which has not been taxed yet. So therefore, you will pay income tax. And then if you're accessing it early, unless you're using the age 55 rule or something along those lines, then there can be an additional penalty. Now, if you have a Roth, which you have to currently make direct contributions to the Roth, they don't have the conversion available yet. That won't be available until next year. Then everything that you've put into that. So if you see $1 million in your TSP, it has a spending capability of about 600,000. And fun fact, I learned that from another gentleman that's on this call that was featured in Money Magazine a few years ago when I was his client. But in all sincerity, the spending power is not what you see. So you have to mentally take a calculation of just subtracting 40% from what you see in your TSP. That's your spending ability. Now, as you get a little bit older, let's say, for instance, and I'll jump back to that annuity supplement that we mentioned earlier. If you're in that space where you haven't collected Social Security yet, right now may actually be a good time, if you're able to start looking at Roth conversions. And so that's paying the taxes up front. And I know that sounds crazy, but believe it or not, even though it doesn't feel good when it's coming out of your check, we're in one of the lowest income tax brackets in U.S. history, and we don't know what it's going to look like in the future. So right now is a good time to take advantage, just kind of bite the bullet per se, pay the taxes up front. And so that way on the back end, you know exactly what you have, and you don't have to worry about any increases in potential income tax rates. And then another thing that's tied to retirement is people oftentimes, we're so happy to get to this mountaintop that we forget that there's going to be a new challenge. So you don't have TSP contributions to offset your tax exemptions anymore. So it doesn't, like I said, taxes don't feel good when you pay them. And then the way that I'm servicing my tax by contributing to my TSP, I don't always want to put the money in there, but it helps me at the end of the year when I file my taxes. Now that I'm retired, I don't have that 23,000. I don't have that 30,000 to write off. And all of a sudden, when I file my taxes, it seems like I've made more money and I haven't prepared. So you want to think that through in advance. Also, with your home, we always get this question about, should I pay off my mortgage? And that's going to be a nuanced question as well. Now, if you are closer to paying off your principal, you don't have the mortgage exemption as far as your taxes on it. I'm sorry, the interest. You don't have the exemption on that anymore. We may say, yeah, go ahead and do it. But if you just bought a house in 2020, it may make sense for you, once we do all the analytics, for you to maintain that mortgage because you're no longer paying into your TSP. This may be the biggest exemption that you have left. So it's just an ongoing conversation as to when I retire, I've reached the mountaintop, but Uncle Sam is still going to want his pound of flesh when he can get it.
I have so many things now that are running through my head as I think about my TSP. I've been in and out of government, and my husband's a Fed. And so I'm now thinking there's a lot of things I hadn't thought about because, you're busy working, you're doing what you need to do. And it's particularly for folks who didn't think they were close to retirement until everything's happening and they're now stepping out of government. It's just something that hasn't been on people's radar. What about healthcare? I mean, now I'm sitting here in my head calculating, got to think about TSP, got to think about taxes, got to think about income. What about with the healthcare? Where does FEHB play into this consideration? And does it impact some of the financial considerations?
It can. So when you're working for the federal government, FEHB is one of the best benefits that you're going to get because it's subsidized by the federal government. So you're not paying the full premium. Once you separate, especially if you're separating before you're eligible for an early retirement, all that cost goes to you. So even if you're offered TCC, which is temporary continuation of coverage, which you need if you're going to have your spouse on your coverage as well, then it's no longer shared by you and the government. You have your half, their half, plus a 2% administrative fee. So in that regard, it may make sense if you are just at a point where I can't take it anymore, or you're leaving where it's not by choice to start shopping on the private marketplace. And so that's one way of looking at it. Now, if you are retiring under an immediate retirement and you have at least 5 years leading up to retirement of credible service, especially if you're doing the MRA plus 10 and the Vera, which are pretty prominent right now, you can carry FEHB into retirement for life. And so that's where it makes where it has a benefit for you is, do I have the credible service? Am I retiring under the right circumstance where it's going to keep the same premium as it is right now? But if that's not the case, we do implore people to start looking at private options, even for healthcare, because it gets really expensive really fast. And it's a very quality level of care that they're going to provide to you if you keep it. However, if I just lost my job, there's tariffs, we're still fighting inflation, that premium may just be too much to bear. So that may be one of the ways that you can tighten your belt until you get to your next stop.
So when we've now hit on healthcare, and we'll take a few questions in a moment here again, but we've hit on healthcare, we've talked about annuities, we've the taxes. The other thing now that we've mentioned but we haven't really dug into is the TSP, thrift savings plan. How does that factor into what folks, you talked a little bit about the taxes potentially changing that, but people have their annuity, they have their TSP. Is there anything else they need to think about if they're staying in government for now? Prepping, I'm still thinking about that word we said earlier about being intentional and taking control of your path. What do they need to think about for TSP now?
So I would say there's a couple things, and it really depends on your age factor. If you're under 59 and a half, then definitely the key is to keep contributing to your TSP. Now we know there's been a lot going on with the market the last couple of months. But remember what your goal is, number one. You definitely want to look at before you make any quick changes to your TSP, think about, your long-term goal that you want to have this money working for you. What happens a lot of times that we see is people in this environment, they tend to switch to the G fund because the market has gone down. And what's interesting, we've done a lot of speaking at events, and we'll talk to somebody who says, back in 2008, 2009, when we had that huge market crash, I put all my money in the G fund and I never moved it out. My intention was to move it out, but I just never found the right time to move it out. And so you've lost all the appreciation that the market had, the huge boom that we've had the last, decade in the market. So always tell people, first of all, be intentional about what you're doing with your thrift savings plan. Keep putting money in it. Yes, it's been a little crazy the last couple months. This is not the first time, and believe it or not, this won't be the last time we see these market gyrations up and down. So you want to first of all stay the course in your thrift savings plan. If you're over 59 and a half, now you have some different options to think about whether you're separated from service or if you're still working in the government. A lot of people don't know this, but even if you're still working and you are over 59 and a half, you do have the option to transferring your TSP to an IRA account. There are some pros and cons to it. One of the things that you can look at is you now have opened up to a whole different array of investment options available. So you can look at some guaranteed accounts that pay a higher rate of return than the G fund does. You can look at some accounts that specialize in creating an income stream, or you can get into different types of investments outside the TSP. Even, and I'll say this and not recommending it, but there are those crypto and other things that you can look at investing in, crypto, gold, and other things that you can look at investing your money in that you can't do in the TSP. Once again, my disclaimer is please talk to a professional before you do any of this. But you have a lot of options available, or you can leave it in the TSP. So you've got a wide range of options, and something that Delante talked about, which was doing the Roth conversion. Even while you're still working and you have a large sum of your money in the traditional TSP, you can shift that over to an IRA and start converting that over to a Roth IRA. So now you're doing a lot of planning, so when you do retire, you have most of your money in a tax-free um, retirement vehicle instead of a taxable retirement vehicle. So with the thrift savings plan, there's a lot you can do. There are a lot of options available, and always, once again, we encourage people talk to a professional and see what's right for you.
Always a good point. Delante, thoughts on that? And I can add a second related question to it after your thoughts.
So I agreed 1,000% with everything Nick just said. The only things that I can really add on to that is one, be intentional about how you're going to turn this into an income stream, because the TSP is an accumulation vehicle. It's meant to save. So if we just picture a mountain, right? Everyone always focuses on how I'm going to get up one side of the mountain. Anybody who follows the sport knows that most casualties happen on the way down because nobody plans for that. So when you get to this mountaintop, you need to have a plan in advance, preferably, of how am I going to get down. And you can't just rely on what's in front of you, because if you say, hey, I'm just going to put it in the G fund, to Nick's point, most people don't ever take it out. Also, the G fund fluctuates, not just based on the market, but there are some, and I say this gently in a nonpartisan way, there are some political aspects of the G fund. So if you want to look a little deeper, look at 2015, look at 2023, where the payouts on the G fund were affected because of things that had nothing to do with the market. Also, if you're looking into just rolling it into a TSP annuity, because I know Nick mentioned that there were some ways of turning it into an income stream, that comes at a fee. And there are some nuances in regards to your beneficiary, to the way that the payouts are structured that work for some, but if they don't, you do have the ability to start comparing different options before making your decision. And that'll allow you the opportunity to see what's best for you and your family. And I'll just use an example of what happened in 2020, 2021. And you told me that we can talk bluntly on here, Jenny, so I'm just going to say it. There were a lot of people who unfortunately experienced the Great Divorce. So you had a lot of families going their separate ways. They just couldn't stand to be around each other during COVID. Now, if you were going into your TSP annuity, the one that's offered to you, I have a surprise fact for you. Your spouse had to sign off on that. You can't just move that without their permission. You can't just give it to them and the kid, like skip past them and give it to the kids. You had to make that a part of the discussion. And so when you're looking at private options, that allows you the ability to forego that. So as Nick said multiple times, and I'm going to agree with them, it's just a conversation to see what's best for your situation and then maximize it into an income stream from there.
That's helpful. I'm taking notes myself because I'm like, I have a TSP, all these things I have, and I think I'm guilty of just leaving things in the G fund a lot of times as
Oh,
well.
Oh,
I know. So I'm learning as we go, which is why it's helpful to talk to folks about this, right? Because it's just things I don't spend time thinking about and should. But somebody asked in the audience around a question around, can you contribute to the TSP if you're not still in government? And no. Okay.
no, you cannot.
the only thing that you can do if you want to add money to it is you would have to opt in for a rollover after separation. So you would either want to create a new IRA, or if you have an existing one, and then you can contribute to a rollover IRA. But once you separate, you can't make any more contributions to your TSP.
Okay. That's helpful, and that's a very easy, clear answer, whether it's what folks, are looking for or not. Um, I know we are getting closer to time here. So, Nick and Delante, are there things we haven't covered, like some of your top tips or questions that you hear from folks that we haven't touched on? I'd love to give space to just dig into any of those.
Yes. So one of the
I'll
things,
touch on something that we
oh, go ahead, Nick.
go ahead, Delante.
All right.
Go ahead.
Look at us being gentlemen today.
I know. You're both being very, very kind here to let each other go. I like it.
Oh yeah, we're both just excited. So one of the things that is overlooked is your FEGLI coverage during retirement. A lot of people think that your payments are going to go, they're going to remain the same. So just how I mentioned earlier with FEHB, if you separate and you don't have that previous 5 years or an immediate retirement, you're on the hook for 100% of the coverage plus a 2% admin fee. When looking at FEGLI, once you start to hit that age range of 50, every 5 years is going to reset because FEGLI is what we call a term policy. So a term is a temporary policy. And so every 5 years is going to reset based on your age. And we like to give people homework. So there's an exercise that you can go do on the OPM. Go to your FEGLI calculator and just put your age in. Go 5 years from there, go 10 years from there, go 15. And then what you'll see is usually your premiums are going to double within 5 to 10 years, and then they'll be about 150 to 200% higher within the next 15 to 20 years by the time you hit 65. And so one of the things that we implore people to do now, we don't turn anything free down. So if you have the 75% reduction and they're going to give you free life insurance, you take that. But if you are someone who needs that high level, so if you're using option B times 5 and it's a need, we implore you to start looking at other options sooner rather than later. So instead of you having a 5 year term, even if it makes more sense for you economically, where you don't have a permanent policy, do a 20 year, do a 30 year, so that way you can at least lock that rate in while you're younger, while you're in good health. And then if you need to turn it into a permanent policy later on, you can do so without needing to do another medical exam, and you can assess what the cost would be prior to making the change versus being caught off guard once you're 65 and ready to retire.
That's great advice, because that, again, life insurance is something that people don't think about always until they need it. And
Absolutely.
so, but that's something to be aware of ahead of time. Nick, you also had some thoughts.
Yeah, and kind of touching on what Delante said, one thing that, and this is for couples, married couples, you definitely want to talk about the pension survivorship option, and you want to have that conversation before you get the paperwork, because a lot of times you get the paperwork and you're rushed to try to get it back in, and you make a selection on option, and it might not be the best option. Definitely want to sit down and take a look at what the household situation is before you select a survivor benefit, because there are a lot of different options out there. And sometimes it might be better to take a lesser survivor benefit. And as Delante said, use some type of life insurance to help make up the difference, because it provides a lot more flexibility, especially if the survivor spouse that did not work for the federal government passes away early. That reduction in pension, you got to go back and try to get that recalculated, but you've still lost a lot of money maximizing that survivor benefit. So there are different strategies. We call it a pension maximization strategy that's available, that can help, get the maximum income available, still have a survivorship benefit there for health benefits. But in the case that a spouse passes away first, you can then shift the funds, and we talk about funds from the beneficiary of the life insurance to somebody else in the family, and you have not taken that huge reduction and hit in your monthly income. And the last thing that I will add, and something that people sometimes don't understand, is that remember that Social Security, a large portion of it is taxable. Sometimes people think that Social Security is non-taxable. Generally speaking, up to 85% of your Social Security benefit is taxable. So understanding that plays a part into, as we talked about taxes earlier as well, that you will have to pay taxes on your Social Security.
That's helpful because, again, all of these are things that people just don't have the chance to think about a lot of times until it's on them. So it's good advice. Any last words before I'm gonna do a few things to close this out? But I'd love to hear some last words. And also, before we even get to last words, if folks have questions for you, because I know people have, we've said numbers of times, people have individual circumstances and it's different for everybody. Can we put your contact info or your website into the chat just so in case people want to follow up?
Yes, please.
So I think it's in the chat for folks on there. Certainly, people can contact Nick and Delante and ask questions. And we will also have this webinar. I think I did not say that up front, but just so people know, because there's a lot that we will have this recorded and posted on our FedSupport.org website. And so, because there's a lot of good info in here, as I was taking mental notes of things I need to, go think about and talk with you, I thought I'm going to have to listen to it again because it is so nuanced and complicated, right? There are so many different pieces of each of these. One thing before we go to my last point for each of you to let us bring it home, we are going to, I don't know if we have a survey tonight. Usually we survey folks, but if we don't have that tonight, Kristen, our producer, may put that out there for folks. But if we don't, and other people on the webinar listening tonight have ideas or other questions that we can tackle in this space, please let us know. Nick and Delante, there is the
Yep.
survey for folks on the line. So it helps us get a sense of what other things people need to know about, because again, I think unpredictable and lots of back and forth. That's kind of the theme of everything going on right now facing federal employees. So there's just a lot of questions. Nick, Delante, any other points, a last final hot take to bring us home for the evening?
I will just say to everybody, take your time and breathe. And I will say also make sure that you're protecting your mental health through all of this. There's a lot of frustration going on, even for those people who have not, gotten the option to leave or planning on staying. Just trying to figure out what their job is going to look like, going into this next phase of life, with a reduced workforce and increase in demands. So making sure from a mental health standpoint, you're protecting yourself. If you need to talk to somebody, please do, because we understand how stressful this really is. We are getting calls every day. So please make sure that through all of this that you're taking care of yourself. I think that's, will be my last parting words. And thank you, Jenny, and your team for the work that you all do for getting this information out there and being a resource to so many people who really need it.
Thank you. If I could nod my head any harder about the stress and taking care of yourself, I would. That's a fantastic, fantastic advice. And Delante, one last hot take from you.
Yes, I'm a big believer that sometimes when you watch a movie, the best ending is the beginning. So I'm going to go ahead and circle back to our first point, and it piggybacks perfectly on what Nick just said. Help yourself start collecting all of your records. Play defense, find your resources. FedSupport is right here for you. You don't have to travel the world looking for resources. They are right here. They have everything you need: attorneys, financial planners, conversation. It's all here. And we're here as well. We specialize in helping you all to simplify the environment, especially when the stakes are high. So whether you're worried about getting your pension estimate right, trying to figure out whether your health insurance or your family carries over, or just really trying to figure out how to get to your TSP without triggering an extra tax or a penalty, we're here to also help take that pressure off and keep things simple. You all have earned your benefits. You've worked hard. You've served. We want to help you. When I say we, that's Opulentia and the Partnership for Public Service. We want to help you to make sure that you are able to access those benefits in a way that helps you to preserve your peace, protect your family, and access the lifestyle that you all have worked so hard to earn.
Fantastic. That is absolutely 100% great message from both of you. So thank you both for being here. Thank you for taking the time. And thank you to all of our listeners this evening. I know everyone's busy. I know it's a tough time. And so really, really just appreciate folks spending time with us and talking through this. And again, this will be online. If folks want to share it, want to look at it again, please keep all the topics and questions coming. And don't forget to visit the FedSupport.org website. You can sign up for newsletters. And again, thank you all for listening, for your service to our country, and for all you do to support your colleagues, your friends, your family. Much gratitude to everyone. Nick, Delante, thank you. And to everyone, have a great evening.